Good afternoon. I'm Rich Justiana, Private Banking Relationship Manager for Nevada State Bank. It's my privilege to moderate client seminars like this. We're always looking to educate our clients about our wealth services and the importance of financial education. Thank you for joining us today as we talk about retirement and income planning from two wealth management advisors, Bo Jenkins and Stephen Magana. Bo Jenkins has more than 7 years of banking industry experience. In his wealth management advisor role, Bo helps clients set financial goals and provides guidance to their financial needs through retirement planning, college planning, investment management, and more. Bo has been with Nevada State Bank for 5 years, during which time he's been a personal banker and a financial services representative. A Las Vegas native, Bo spends time helping youth and community through his church. Steve Magana has 2 years of banking experience and another 11 years of wealth management experience as a financial advisor working with high net worth individuals through private banking. He assists clients with an array of financial planning goals, including investment portfolio management and guidance on wealth management services. Having recently moved to Las Vegas from Chicago, Stephen serves as a treasurer for a Chicago-based nonprofit that offers low-cost spay and neutering services to the local community back home. He looks forward to continuing his volunteerism in the Las Vegas area and helping educate area residents on financial matters. At the end of the presentation today, you will have a question and answer session. Please use the chat feature to send questions. You can do so at any time and we'll address them at the end. Again, thank you for joining us today. Steve and Bo, I will turn the time over to you.
Thank you, Rich, and thank you all for joining us here today. While we are working, so many of us are guilty of the same behavior. We put our noses to the grindstone and focus on building up the biggest amount of money possible and hoping that it will be enough to last. Oftentimes, we find that clients don't consider how to spend those savings until they have already retired. This is one of the main things we focus on with clients. Today, Bo and I wanted to share with you how we go through the retirement income planning process with clients. There are a few things that you want to consider when thinking about retirement and help you fully understand what it takes to transition from working and accumulating assets into that phase where you stop working and we get to spend that pile of money we've been saving and growing our entire lives. We'll also share some of the things that you can do to help your money last throughout retirement. We're going to be getting to all of that here today, so thank you for your time, and without further ado, let's get started. I'd like to begin today by asking you all to take a second and close your eyes and picture what your retirement looks like. Do you see yourself on a beach or at home working in your garden? Are you on a golf course or touring wine country? Is exotic travel in your future, or quality time surrounded by your family more your ideal scenario? I want you to take a minute and really picture what that looks like for you and who you are with, and really think about how you're going to spend your time when you no longer have to spend it working. Not only do you have to picture what you want your retirement to look like, but when do you want to retire? For some people, it's as soon as possible. Others will try to work as long as they can. There really is no right answer. You have to figure out what you want to spend your time and what that means to you. How long will your retirement last? Now, if we knew the answer to this one, retirement planning would be a whole lot easier. But the fact is, Americans are living longer and longer, and that means we need to save more. We need to make sure that we have the income and savings to fund those expenses for an even longer period of time, especially as life expectancy is expected to increase over the next couple of decades. When we started, I asked you to visualize what your retirement looks like, and I wanted to circle back to that here because it has a very big impact on retirement planning and some key considerations you'll want to weigh. Some clients have very expensive lifestyles. Maybe you want to spend your time going on different cruises, seeking out new and exciting cuisine, or spend time working on old cars. Maybe you've just become accustomed to living a certain lifestyle, and you want to make sure that you can maintain that level of comfort. And that's okay, but if so, you'll need to plan accordingly. On the other hand, there are a lot of clients who want to plan for a more modest retirement. Maybe you want to spend your days reading or volunteering in your community. Those clients might not need as much money in retirement to achieve their goals. Whatever you want your retirement plan to look like, you need an income plan to match. Another consideration in retirement is where to live. When considering where they wanted to settle, many of my clients have told me, I want to be somewhere where I'm close to the kids. Others say, I want to settle somewhere warm so the grandkids will have an exciting place to come when they come visit. Maybe going somewhere quieter with a lower cost of living is your dream destination. There is no wrong answer to what this looks like for you and for your retirement. Once your needs and wants are accounted for, many clients want to make sure that they can provide financial assistance for their family. Sometimes that means gifting to children and grandchildren while they are alive, or maybe that means helping fund their college education. Others want to plan on leaving a certain amount of money for their children once they are gone. Then we also have clients who say, I want to die with $1 in my pocket and focus on spending their savings on their retirement. Once again, there is no right answer, but think a little bit about your own personal situation and what's important to you. That is one of the key things that we want to focus on here today, and whatever might be important to you in retirement, we want to understand it and help you plan for it. Now I'd like to turn it over to Bo Jenkins to tell you more about some of these topics. Bo?
Thanks, Steve. Diving a little deeper into when you want to retire, it's important to keep in mind that the earlier you retire, the less time you're going to have to save for retirement, and the longer you're going to need those savings to last. A couple of key ages to consider are when you're eligible for Social Security and Medicare. Currently, you can receive your full Social Security benefit amount between age 66 and 67, depending on the year you were born. But you can take a permanently reduced amount as early as age 62. Now, because you're not eligible for health coverage under Medicare until age 65, many clients will target that as their retirement age. We have helped clients see how we can budget for private health insurance that bridges the gap between your working years and age 65 if you're looking to retire sooner and have the assets to do so. Now, when it comes to your retirement, how long of a period should you plan for? The good news is that we're living longer lives. However, that generally translates into a longer period of time that you'll need your retirement assets to last. The average 65-year-old can expect to live for at least another 2 decades. With modern medicine and life expectancy that has increased at a steady pace over the last few years and is expected to continue increasing, we cannot solely rely on family medical history. The point that I want to make is for many of us, it's not unreasonable to plan for a retirement that's going to last 25 years or more, which means your income and savings will need to last that long as well. Now, every retirement income plan must balance 3 main goals. The first is to maximize your ability to enjoy your retirement. That means making sure you have the financial ability to do the things that you want to do. You've worked hard and now it's time to relax or celebrate. Secondly, is to minimize the chance that you will outlive your money. And finally, is to manage any financial risks of unwelcome life events, such as serious illness, a need to pay for long-term care, or other unexpected expenses that you and your family may face in retirement. All right, Steve, can we break down that planning process?
Absolutely, Bo. Now that we've talked a little bit about what you want to do during retirement and some of the variables that come up, we really want to focus on some of the numbers and the actual process when it comes to income planning to help you address the fear of running out of money. We use a 5-step process that we're going to walk you through today. When it comes to income planning, we start by getting an estimate of what you'll need to maintain a comfortable lifestyle during retirement. Next, we look at all of your sources of income during retirement. Things like pension, Social Security. Maybe you have income from a rental property. Then we can identify any income gaps when it comes to the money you have coming in versus the expenses. From there, we can make sure that you have the appropriate asset allocation strategy, one with your goals and your needs in mind. Finally, we'll talk about some of the major factors that some people don't take into consideration, like inflation, healthcare spending, and unforeseen emergencies. Bo, could you tell us a little bit more about how these numbers work?
Absolutely. When trying to figure out how much income you're going to need on an annual basis in retirement, you may be tempted to rely on some general guidelines. You may have heard in the past that you should plan on needing somewhere between 70% and 100% of your pre-retirement income once you retire. But using a general guideline like this one, while easy, really isn't very helpful because it doesn't take into consideration your unique circumstances, your expectations, or goals. Instead of using an arbitrary percentage, focus instead on your actual expenses today and think about whether they'll stay the same, increase, decrease, or perhaps stop altogether during retirement. While some expenses may disappear, like a mortgage or the cost for transportation to and from work, new expenses may arise, like lawn care service and home maintenance, things that you might currently be taking care of yourself, but may not want to or be able to do so in the future. Additionally, if travel and hobbies are going to be part of your retirement, you'll want to be sure to factor in these costs to your budget. I help a couple who like to go on at least 3 cruises a year, and for them, we plan for an extra $25,000 in expenses each year just for travel. Another client has an accounting for his fuel and hangar costs on a little hobby plane he has and takes out every couple of weekends. So an accurate accounting of your estimated expenses is essential when you're planning for retirement income. Now, we're going to look at this table for a minute and let me try and help you understand what it's trying to show. And keep in mind, it's just for illustrative purposes and it's a worst case scenario. So it assumes a couple of factors that can't be guaranteed. And that includes a 3% annual rise in your salary before retirement, a 3% annual inflation rate, both before and during retirement, and then a 4% annual rate of return on the savings during retirement. Now, these figures also assume that you're going to start with no savings and that you'll have no other sources of income in retirement, not even Social Security benefits. So this table is really just meant to give you a general idea of how much it actually takes to provide 70% of your final working salary over a 25-year retirement. So here's how it works. If we look at the top left here, we'll see someone who currently makes $40,000 a year and is planning to retire in about 10 years. They'll need to accumulate more than $800,000 to provide for the equivalent of his or her final working income to last over 25 years. On the other end of the spectrum, looking there at the bottom right, someone who makes $80,000 a year and is planning to retire in 20 years may need over $2.2 million. Now that's a pretty big nest egg. The main reason we're looking at this table again is just to give you a general idea of the true cost of a retirement and to shine a spotlight on the importance of planning and contributing now, today. And we don't want you to get too caught up on the dollar amounts of this chart because we at NSB can run a complementary analysis to see what is needed for your specific situation. In addition to your savings, there's going to be other sources of income, and we like to think of retirement as a 3-legged stool. First being Social Security benefits, second being an employer pension if you have one, and third being your retirement assets. Now, with employer pensions being less common in the workplace today, individuals need to focus now more than ever on what is in their control. So let's start by taking a look at one of the aspects you do have some control over, and that's the first leg of our stool in Social Security. Today, over 94% of US workers are covered by Social Security, and the amount of Social Security retirement benefits that you're entitled to is based on the number of years you've been working and the amount you've earned. Your benefit is calculated using a formula which takes into account your 35 highest earning years. And the best way to know how much you can expect in benefits is by signing up for a My Social Security account on the Social Security's website, ssa.gov, and view your Social Security statement online. Your statement contains a detailed record of your earnings, as well as estimates of retirement, survivors, and disability benefits, along with other helpful information about Social Security. The earliest you can begin receiving your Social Security retirement benefit is age 62. And if you decide receiving benefits before your retirement age, remember that ranges between 66 and 67 depending on the year you were born, there's a drawback. Your monthly benefit will be permanently reduced somewhere between 25% and 30% less than it would have been had you waited until your full retirement age. Conversely, you can also lock in a higher monthly benefit amount by delaying past your full retirement age up to age 70. So every year between your full retirement age and age 70, your benefit amount grows by a guaranteed 8%. Now remember, by taking retirement benefits before your retirement age, you're getting a smaller monthly benefit. And working in retirement can also affect your Social Security retirement benefits. And that's something you'll want to keep in mind. Also worth noting is the federal government periodically adjusts Social Security benefits for inflation. But the bottom line is, for most people, Social Security alone isn't going to provide enough income in retirement. But it's important to draw it at the right time to maximize your benefits, and we can help you determine an ideal time as part of your retirement income plan. So let's go ahead and pause for a moment and try to tie some of the things we've discussed together. We've talked about estimating an annual expenses in retirement. And we've talked about estimating annual income in retirement. With very few exceptions, most of us are going to find that there's a significant gap between what we think we're going to have in retirement income each year and what we think we're going to need each year. This gap is represented by the amount of additional income that we're going to need to make up through savings and investments. For example, if we estimate that we're going to need $75,000 each year to maintain the retirement lifestyle we want, but project that we can only count on Social Security to provide for $40,000 in income, we have a $35,000 shortfall. And again, we're going to have to rely on those savings and investment to fill that gap each year. Steve, can you share with us how allocation can help?
Yeah, absolutely, Bo. Sorry about that. When we look at your asset allocation or how your retirement assets are invested, there's a big transition that we go through when we go from accumulation to distribution. When we're young and working, say in our 30s or 40s, like Bo and I, we focus on saving and building our retirement nest egg as much as possible. Our focus is growth and accumulation. But when we retire and have to start spending those savings, and often those same investments that provided us with growth for all of those years may not be the best strategies for distribution. Once you start relying on savings for income, as Bo discussed, we don't want to put you in a position where you have to sell in a down market because you need the money to live off of. Our goal when it comes to retirement planning is to minimize the volatility while generating the income you need to supplement your additional sources of retirement income. At the same time, we have to balance our immediate income needs with our long-term return needs and our need for growth for the long term. Because there is also risk of not earning a high enough return on the assets and finding ourselves in a situation where we run out of money sooner than we expected and end up outliving our money. So it really is about finding the right balance between growth and income to help make sure our savings can last for 25 years or longer. Finally, in our calculations, we have to take into account inflation, which we'll cover further in a little bit later on. So what does asset allocation look like in retirement? Well, the answer is different for everyone, but it will usually be some combination of equities and fixed income. There are many different types of equities. You can own individual stocks, mutual funds, exchange-traded funds, maybe some real estate exposure. And that's the portion of your portfolio that's focused on growth over the long term. On the other side, we're going to use fixed income to lower that risk and provide more consistent income and returns. That will be through things like bonds and different products that have less market risk and volatility associated with them. A big thing that we're going to look at is your withdrawal rate, and the order of withdrawals, which we are going to take a deeper look at in the coming slides. How much we draw down from our retirement savings is one of the most difficult balancing acts you'll face when it comes to income planning. The goal is to find what's called a sustainable withdrawal rate, or how much we can take out of our savings and turn it into income each year and still make sure our money lasts throughout our projected retirement. You may have heard about an old rule of thumb of drawing down 5% or 4% as typical rates, but that rule has changed over the years, going down from 5% to 4%. And that will be a mix of drawing part of your earnings and some of your principal over the course of your retirement. The tricky thing is, a lot of it depends on market performance over the course of your retirement, and that is something that we cannot completely control. Now, this is very important, especially in the early years of retirement, and we're going to take a closer look at that right now. Something a lot of people who we speak with are not familiar with the concept known as sequence of returns risk. Basically, what this means is even though you may be looking for an average return of 4% to 5% or even 6% year over year, there are going to be years that are higher, and there are going to be some that are lower. But the order in which those returns come really makes a big difference, and especially during the first years of retirement. If you have some negative returns in the early years of retirement, you may be forced to lock in those losses in order to generate the income that you need. What that can really do is hurt your ability to recover and make it difficult for your desired plan to come to fruition and last for your retirement. I've got a couple scenarios to show you how sequence of returns can impact your retirement. The first scenario is going to look at starting retirement in an up market. In this case, the client is starting their retirement with $1 million in savings and plans to draw down $50,000 annually at the end of each year, adjusted for inflation at 3.5% over the course of their retirement. The first year they earn 27%. The next year they earn 9%. The third year they earn 7%. And in the fourth year, they lose 15%. That comes out to an average annual return of right around 6%. The next slide shows us starting your retirement in a down market. It's the exact same numbers, but we flip the order of return. So in the first year, we see that 15% loss. The second year, 7% gain. The third year, 9% gain. And finally, up 27% in that last year, giving you the same approximate annual return of 6%. And we can see the results of this risk on the next slide by looking at these two scenarios side by side. The line in the blue line shows the portfolio starting in a down market, and the teal line shows the outcome from starting in an up market. By locking in those losses in the early years, you limit the portfolio's ability to recover and generate the gains you needed to generate your future income. In fact, the difference between starting in a down market and an up market cost these clients nearly 13 years worth of the spending that they needed for their retirement. So what does this look like in practice? Well, let me tell you an example of how this worked for two of my clients, Sandy and Joe. I started working with Sandy and Joe back in 2010 after Sandy inherited an IRA from her mother. After seeing their friends and family members have to delay retirement following the Great Recession in 2008, they planned to work until 67 and were worried about repeating the same fate. Their target retirement date just happened to be 2020. And what did we get? Another recession, right before they went to retire. But we had a plan, and we had worked together over the past decade to not only manage their investments, but also prepared for retirement by paying down debt and prepared a budget that took into account all the spending that they would need to maintain a comfortable lifestyle. We started reducing risk across certain parts of their portfolio beginning 2 years prior to their retirement, because that's when it showed that big losses right before retirement posed a greater threat than lower returns to the success of their retirement plan. As a result of our efforts, the clients were able to retire on schedule last year and actually could afford to spend an extra $1,000 a month and still have a 95% probability of successfully funding their goals. We help a lot of clients on a regular basis, answer the question of where I take my money from, even before they enter retirement. The example of Sandy and Joe was made possible by taking advantage of both tax-deferred accounts like 401ks and traditional IRAs, along with tax-exempt accounts like Roth IRAs and taxable accounts for excess cash savings that they could no longer contribute to those qualified accounts. By taking all these different factors into account, we were able to use savings now to allow them to delay Social Security to secure a higher guaranteed benefit for the rest of their lives. Remember, at age 72, you have to start taking withdrawals from qualified accounts. Often, it can make a lot of sense to use some of those savings in the early years of retirement to secure a higher Social Security benefit without having to continue to work. As you can see, there are a lot of moving pieces, and having a plan can help navigate whatever life throws at you.
Okay, in this last section, we're gonna go over a couple other factors that need to take place and make that retirement income planning so challenging. Before we get to your questions, the first is inflation. Second being taxes, and then health and long-term care, and finally, some potential risks. So inflation. We've touched on this several times today, and it's because unless you accurately account for inflation, you're likely underestimating the amount of annual income that you'll need in retirement. Inflation is basically the increase in goods and services over time, or think of it as the purchasing power of a dollar declining over time due to the rising cost of goods and services. At a 3% rate of inflation, a given sum of money will lose over half of its purchasing power in just 25 years. At 3% inflation in the real world, a gallon of milk that costs $4 today is going to cost well over $8 in 25 years. Keep in mind that inflation doesn't affect all goods and services equally. In fact, retirees can be affected by disproportionate increases in the cost of some things. For example, the cost of healthcare has historically increased at a rate higher than the average rate of inflation. So we'll need to plan for more money in retirement each year just to keep pace with those rising costs. Now, the impact that taxes can have is sometimes overlooked. Taxes can eat into your income, significantly reducing the amount you have available to spend in retirement. You'll want to be certain whether the income you're accounting on is or is not subject to tax. For example, many are surprised to learn that a portion of Social Security retirement benefits may be subject to federal income tax, depending on your filing status and total annual income. You'll also want to make sure that you understand how your income is taxed by consulting with your accountant or CPA. But keep in mind that some income, like interest, is taxed at your ordinary income tax rate, while other income, like long-term capital gains from investments and qualifying dividends, they benefit from a special and currently lower tax rate. A few specific investments can generate income that can be altogether exempt from federal income tax, as well as state tax in some cases. You should also understand how distributions from a tax-advantaged accounts, like your traditional IRA and 401ks, are taxed. Generally, to the extent that the distribution is from an account or plan that represents earnings or pre-tax contributions, like that of a traditional IRA where contributions are deductible, once distributed, it's going to be taxed at your ordinary income, regardless of whether the investments within the account may have generated long-term capital gains or those qualifying dividends. Special rules also apply to Roth IRAs and Roth 401ks, as well as other Roth accounts. So qualified distributions from these accounts are federally tax-free because you've paid taxes prior to making contributions, so both the principal and growth are tax-free. Next, we're going to look at major retirement expense to consider, and that's healthcare costs. Once you retire, you're likely going to focus more on healthcare than ever before, and there's a greater chance that you'll need to access our healthcare system. Now, most Americans are automatically entitled to Medicare coverage once they turn 65. When you're eligible for Medicare, you'll have to decide on what additional coverage to purchase, including physician care, laboratory tests, and physical therapy. you may want to join a Medicare prescription drug plan. And you might also consider purchasing a Medigap policy that offers additional coverage that Medicare won't pay all of your healthcare expenses. Now, some people think at 65, hey, I'm still working, I'm covered by my employer's plan, so I don't need to do anything. Well, no, it's actually really important that you still apply at age 65. If you don't, you can get hit with a permanent penalty that will add to your monthly cost. Another misconception out there is that Medicare will cover my long-term care needs. And it's important to understand that Medicare won't pay for long-term care if you ever needed it. As such, it's important to consider the potential impact a prolonged stay at a nursing home could have. Long-term care refers to the ongoing services and support needed by people suffering from a chronic health condition or disability. It's hard to face the fact that our health might decline, but statistics suggest that most of us will need to account for long-term care during our lifetime at some point after we reach age 65. And currently, the nationwide average for the cost of one of these, a one-year stay at a semi-private nursing home, tops at about $82,000. But in some states, it's even higher. And in the future, long-term care will likely cost even more. Going back to a 3% rate of inflation every year, and remember that's conservative for a rise in healthcare expenses. In 20 years, a one-year stay at a nursing home could cost close to $150,000. If you needed it, how would you pay for this care? You might consider paying out of pocket, which means you're going to use up your income, your savings, investments, assets, such as your home or others, to pay for any potential long-term care costs. But paying out of pocket is truly a gamble unless you're extremely wealthy. A lot of people assume that Medicaid will pay for long-term care costs. Now, you might be able to rely on Medicaid, but there's a catch. Your assets and income must be low enough to allow you to qualify, meaning that you'll have to use up most of your savings before you even qualify for benefits, aside from a personal small needs allowance. You'll have to use up all of your retirement income, including your Social Security and any pension payments, to pay for your care before Medicaid pays anything. Now, another option to consider in long-term care insurance, which may provide a source of funds for long-term care expenses, but you have to account for those premiums for this insurance when you're making your retirement income and assessing those needs. Again, all of these are things that we regularly cover with our clients as we review their complementary retirement analysis at Nevada State Bank. Lastly, we're going to look at understanding a couple of risks. Every sound retirement income plan should involve an understanding of these risks and how they can influence your available income in retirement. Some risks that need to be accounted for include longevity risk, which is the risk that you may outlive your investments, health risks, or the risk that is your healthcare costs may erode faster than your savings had expected, market risk, and this is in line with what Steve had explained with sequencing of returns. This is when markets underperform or they don't perform at the rate you need it to. Reinvestment risk is the potential risk that you may have to reinvest at a lower rate of return than your prior investment, or take on some additional risk to achieve that same level of return. This type of risk is often associated with fixed interest saving instruments, such as a bond or a bank CD. There's also interest rate risk, and this is when interest rates have risen, the price of some existing investments drop. Again, often associated with bonds and fixed income products, but in this case, rates have risen prior to your investment maturing, and so it makes the bonds you own less appealing on the open market for buyers, as they could go and find a higher paying coupon in a newly issued bond. Lastly is expense risk, and this is the need to pay for life's unexpected life events and having enough in savings to absorb these occasional one-time big ticket items.
I know we've covered a lot of information over the past 35 minutes here today, and I wanted to make sure to leave some time to take your questions. But before we open it up to you, I wanted to stress that while there are some things you can control and some things you cannot, Preparing for retirement starts with a plan. That plan should help serve as a roadmap to help guide you to retirement and through your retirement. That plan should help you invest regularly, maximize the impact of tax-deferred vehicles like 401ks or IRAs. And as we've discussed, the earlier you start planning, the better. Putting off planning only makes it more difficult to succeed. Please speak with an NSB Wealth Advisor to learn more about how we help our clients using NSB's complementary retirement analysis. So with that, I'd like to thank you and open it up to all of your questions.
Keep in mind, we're going to put Steve and Bo's contact information in the chat at the end. If your question isn't answered, feel free to email one of the advisors with your question or leave your contact information. Let's go to our first question. Question is, I plan on retiring in 1 year at 65 years old. Can I transfer my current 401k to a much more secure IRA or IRA CD now to protect what I have built up and still continue to fund my current 401k until I retire?
The answer to that is it depends on your plan. Some plans allow for what's called an in-service distribution that allows you to move the balance from your plan after age 59 and a half, even if you're still working at the company. That would allow you to move it into an IRA and take advantage of whatever investment option that you choose. That's something that we could help find that information to you. We would be happy to do a joint phone call with you and call your your plan provider to see what your options are.
Okay. One more question. What about using part of cash value in life insurance policies?
Life insurance is an interesting topic when it comes to saving and planning for retirement. Typically, when we talk about insurance, we typically want to make sure that we're covering liabilities. And so there are times when it makes sense to use some of that cash value plan to position and pay for retirement. It's not necessarily the best retirement vehicle, but it's something that we can help analyze what your options are and help you understand the impact of drawing the funds or leaving them in the insurance in the current policy.
Okay. Another question. In Medicaid, isn't there a look back period for asset transfer?
I know they do have a look back period when you're qualifying for Medicaid. So it's not like in your final years of retirement, knowing you're going to need to apply for Medicaid, you could just gift your money. You are going to have to be spending it on your care. Steve and I would be happy to go into the specifics of your situation to see if that's something that we can account for and mitigate any liabilities that you may have as a result of it.
And to add on that, that's why you want to have things like trusts, things like your IRAs, things like that in place now, so that when you get to that point, those vehicles are already in place for you to be able to take advantage of.
Okay. Another question, long-term care insurance premiums. Do you have an estimate of cost or a range of costs?
There's a traditional way that long-term care was kind of purchased. It would be monthly premiums throughout your lifetime. And there's been a couple advancements to taking different approaches now that are available to us. So we would discuss that individually. Sometimes there's like a one-time lump sum premium, and it actually can enhance the benefit amount that you receive to be used for long-term care purposes. And we can make sure we list beneficiaries in the event you don't end up needing that insurance. So again, meeting with us, we'd be able to address the best way to go about making that purchase.
Okay. Another question. Is there ever a time it makes sense to draw Social Security early, say it's 62, when you first become eligible?
Yeah, absolutely. Everyone's situation is going to be a little bit different. There's some pretty big age gaps between spouses sometimes, and if there's different earning histories, that could lead to making sense of having one spouse draw earlier than the other. And really, if you start drawing your Social Security benefits early, it's nice to think that you're going to be collecting more checks, because that's 4 more years or 3 more years of checks that you're getting in. But it's going to be at a reduced rate. So we're actually able to calculate and help clients find out what their break-even age is, like how long do you have to live, and in order to see that you truly made more money by delaying instead of taking it too soon. Really, it's important to make sure we not only calculate that break-even age, but then also take those figures and put it into our plans and model out for you the impact that different withdrawal strategies can have, to help our clients understand how taking an early or drawing at full retirement age or delaying until age 70 is going to affect their retirement plan. So we'll definitely answer that with you individually and map out how it affects you, instead of just, yeah, take it right now or don't.
Okay. Here's a good question. What if I plan to continue working during retirement?
Yeah, I'll take that one too.
Sure.
So it's a really good question. Many people actually continue to work after their official retirement. Sometimes it's out of necessity. Sometimes clients may have always wanted to start a business, and their retirement finally gave them the opportunity to pursue that goal. Some people are going to find jobs that they may have always wanted to have, but never had the time to do while they were in their working years. So if you continue working in retirement, it's important to account for that income as part of your plan. Working during retirement can impact not only when you begin drawing Social Security or pension benefits, but also how you allocate your investments and when you should begin drawing from your qualified accounts, and so much more. So really, you'll want to make sure you meet with us, and we really get an accurate income figure, because we don't want to say like, oh, working this part-time job is going to give me $20,000 per year, and then it only bring in 10, because that's just going to leave you with another one of those income gaps in your retirement plan. So if you plan on working during retirement, then we need to account for that income in our plan as well too.
Okay. I think we have time for maybe a few more questions. This question is a little bit more involved. Question is, my wife and I are both retired. Recently, with the passing of my mother and my father, I received through a trust an IRA valued at approximately $200,000. Additionally, I received another $300,000 in cash from the sale of their home and various bank accounts. With the cash, I paid off my house. My question is there a time limit on the IRA with regards to the length of time I can keep it open? I'm very new to all of this. Currently, the IRA is being managed with another company.
Yeah, I can speak on that a little bit. Inherited IRAs have some very specific rules as opposed to your own IRAs. Basically, the money in those accounts, the IRS is waiting for that tax dollars, and the person that owned the original tax deferred benefits is no longer there, so they want their money. They recently changed the rules where it depends on when mom passed. If it's been within the last year or two, she's going to fall under the new rules, and there's specific rules to a trust. Typically, if it's an individual that owns the IRA, you have a 10-year window, is I believe what it just changed to draw those funds down. But there are special rules for the trust depending on what the trust says. But typically, an inherited IRA needs to be drawn down over a 10-year period. We'd be more than happy to meet with you and discuss the specifics of your situation and help you understand the impact of drawing those funds versus the non-retirement funds and how those two things can work together.
Yeah, and I just saw in the chat too that it was just this last July. And so absolutely, there's going to be a 10-year period in which the IRA is going to need to be liquidated. But we would work closely with you and your CPA to make sure we take that income in the best years to mitigate any tax consequences.
One more question. Can you explain the difference between traditional and Roth IRAs or a 401k? Which one should I choose?
Sure, absolutely. That, like so many things, is it really depends on you and your situation. To kind of break it down simply, I would think of traditional IRAs as tax deferred, while you can think of Roth IRAs as tax free. Here's how that sort of works. When you're working and contributing to your traditional IRAs, that money is being deducted from your taxes. And you're not paying tax on the money that goes in, and you're not paying tax on any of the growth. All right. So when you benefit from not paying tax on that growth, but then in retirement, when you're no longer working and you start taking money out, those withdrawals are taxed as ordinary income, which in theory should be lower than when you were working, and you're paying a lower effective tax rate on that money when you're retired. With Roth IRAs, it's a little bit different. You don't get to deduct the money you contribute, but when you draw the funds out in retirement, the money you put in, along with the growth, are all tax-free. As long as they've been in that account for at least 5 years, you have tax-free income. The key element in determining what is the right plan for you is typically how long you have to enjoy the benefits of that tax-free growth. There's some simple tools and calculations that we can use as part of our planning software, where we can actually model out the difference between a tax-free and a tax-deferred account, and show how those two different scenarios can impact your individual scenario.
Okay, we have time for one more question. This will be the last question. How do you know when is the right time to start making your investments more conservative?
Yeah, that kind of ties back into asset allocation and what we discussed earlier. And many people, look for that rule of thumb. There's an old rule of thumb I really don't like them, but it can help you understand where things are at. The old rule of thumb says you take 100 and you minus your age, and that's how much stock you should own. So if you're 40 years old, then you should be about 60% of your investments in equities. And if you're 60 years old, you should only have about 40% of your investments in stocks. But what happens if you plan to retire early? What happens if you start saving later in life, or your situation just dictates that you need to stay aggressive during retirement to help grow your retirement assets and offset inflation? The best way to know about when to start making changes to your retirement portfolio is by speaking with an advisor and building a plan that takes into account your retirement goals.
Well, thank you. So advisors, do you have any final words you'd like to share?
Yeah, really just come and talk with us. It won't cost you anything to talk about the importance of saving and planning. And if you just do that, you're doing a lot more than most people.
Stephen?
Yeah, I think that's great. I think Bo hit it right on the head. There's no charge to come talk with us. We're here to help, and you'll be no worse off for coming to meet with us and showing you how we help our clients plan for retirement.
Great. Well, we're right at the close of the time allotted, so we will come to a stop. Stephen Bo's contact information is on the screen and also in the chat. Please feel free to contact them if you have any additional questions, or if you'd like to schedule time to chat with them. Again, thank you for joining us today, and have a great day, everyone.